how can they run their deficits and their fiscal expansion um, without issuing equivalent treasury bonds?
So they're going to likely draw down their Treasury general account, and so the Treasury has a large account at the Federal Reserve that's basically their checking account. And so if you look back over the past year, they actually issued more treasuries than they spent money out, and so they accumulated the largest ever TGA account, and so they usually, historically it's been below $400 billion, and even that was the high end of their previous range, and then lately they got up to 1.8 trillion. And now last I checked, it might be 1.6 trillion, but it's really high up there, and so they can pull down by about a trillion. And so they gave year end or quarter end targets for where they plan that TGA to be. And Mnuchin kind of did the same thing where they would say, we plan to end the quarter at like 800 billion, but they never did. They just kept issuing more, kept that level very high. Whereas Yellen seems to, by changing it and not issuing as much, and then giving that target, there actually seems like they're going to draw that down this time and normalize that back down to, probably a little bit above 400 billion. And so that's one thing they can do. However, if they were to say pass this 1.9 trillion dollar package that some of the politicians are discussing, they're going to have to go back to markets and issue more. That's basically saying for now they don't need to issue as much because they can draw down from that cash balance.
So can we extrapolate then? I'm just going to work through the mechanics, see if I got this. So if the fiscal stimulus package is considerably smaller than is being bandied about, they will not need to go back to the market for as many treasuries, and therefore they can draw down the Treasury general account, and the issuance will be lower, and we could see a continuation of this downtrend in the dollar. But if they do pass the larger end of the stimulus bill, they will need to continue to issue treasuries, and we could see a tactical bull market in the dollar for a quarter or two while the market absorbs this new issuance.
Yeah, so that's one of the key questions I'm watching because as much as the Fed is buying, and I had this discussion before when I was kind of debating with people about the dollar strength. And so one of the things was that over the next couple of years, I expect the Fed to be one of the more aggressive in terms of expanding its balance sheet, but it won't be necessarily the most aggressive in any given quarter. And so in early 2020, they were by far the most aggressive in terms of their balance sheet expansion compared to Japan, compared to Europe. But then as you got towards the later part of the year, they've been on this kind of more steady approach of buying, increasing their balance sheet by about 120 billion a month, which is funny because that's one of the most dovish periods in monetary history. But it's actually like less dovish currently than the ECB. And so it's also relatively dovish compared to the amount of treasuries that are being issued over the long run here, because we're running, in addition to unprecedentedly dovish monetary policy, you have even more unprecedented fiscal policy. And so the issuance compared to that purchasing rate is actually, pretty significant. And so, if we get to a point where we have another quarter where it looks like the Treasury is going to issue, say, $1 trillion in net treasuries, and the Fed says, okay, we'll buy a quarter of it, the other three-quarters of it, like have fun. Private market can absorb that. You can get higher rates, and you can also suck dollars out of the system, and that can stabilize the dollar and potentially shoot it up until you run into a problem of either treasury auctions not going very well, or something blows out like a repo issue, or you might have a liquidity event similar to Q4 of 2018, where you had the stock market fell 20% very quickly. You had growth stocks fall even more, like Apple was off more than 30% very quickly. You had no junk bonds issued for 6 weeks because credit markets, is that's a more severe problem than the stock market is if the credit market's frozen. And so if you were to get some sort of issue like that, the Federal Reserve could potentially have to step up their purchases. But that's somewhat of an onerous thing for them because that basically threatens their independence. And so you always kind of have this fragile independence of central banks, where you're not supposed to just do whatever the fiscal authority says and just monetize whatever they want to do, but they might find themselves forced to, and that's basically what they found themselves in back during the repo spike, where they just had to go against their plan and start expanding their balance sheet in an economic expansion. And so they could find the same thing, say in late 2021, where they prefer to normalize, and instead they have to potentially buy more. And but they're probably not going to do that unless the market has a pain point or something breaks. And so there's that kind of that quarter or two period where you could have a stabilization of the dollar and you could have rising rates until it causes an issue somewhere.